So hi everybody, just like to say really good job Max, very interesting, and we have quite a similar study, so we'll get all the bond related stuff out firstly. I hope you're all having a really great afternoon. Today I'm going to be presenting my thesis, which is titled The Road to Cheaper Debt, Sovereign Bonds and Infrastructure Investment. And I'd just like to thank my mentors, Kathy, Christina, Kylie and Deb from the ESG panel, and also Laura Ryan from Ardea Investment Management, for all of their contributions and guidance throughout the process. Okay, so firstly, just to run through what I'm going to cover today, I'll recap my research question and the rationale for looking into the area of infrastructure, climate and sovereign bond yields. Then I'll outline the main model that I'm using to estimate this question. I'll present my main results, each linked to my hypotheses, with some additional interesting findings. I will also cover the robustness checks that I've implemented so far. And finally, I'll summarize the limitations, contribution, and implications of this work. So my research question is, what is the effect of infrastructure investment on sovereign bond yields? This research will analyse infrastructure investment across 40 countries between 1995 and 2019 to determine through a climate lens if infrastructure materially affects government cost of debt. So the relevance of this question and its importance is heavily tied to climate transition risk. Prior literature has shown that in countries where high climate vulnerability was observed, sovereign bond yields were also observed to be higher. Public infrastructure assets have really long lifespans, so they affect countries' emissions well into the future. And the infrastructure investment decisions are particularly important as we approach key dates around climate scenarios, particularly outcomes to 2030. With regards to the Sustainable Development Goals in particular, infrastructure is heavily tied to their outcomes, with 72% of the 169 SDG targets being directly or indirectly linked to infrastructure. And you can see that impact diagrammatically on the current slide. So I've used a fixed effects panel regression with both country and time fixed effects and robust standard errors to estimate this question. And the underlying panel, again, covers 40 countries over 25 years. My independent variables are 10 and 3-year government bond yields. The first set of dependent variables relate to infrastructure investment, specifically investment into rail, transport and total infrastructure. The renewable investment proxies that I've used relate to the change in a country's contribution of renewables to the total primary energy supply, and also the change in this quantity measured as tonne of oil equivalent. The reason there are two measures for renewables is to try and capture both the relative and absolute change in the renewable proportion of a country's energy supply. And the reason that they have to be proxies is because the predominant data source I used was OECD data, which unfortunately the OECD doesn't currently count energy as infrastructure, and so it doesn't really have a lot of reporting on investment into any kind of energy infrastructure. Then I have two additional infrastructure related controls in the model, being the quality score and maintenance investment. These are included as they likely impact the existing stock of infrastructure in an economy, and therefore is going to have impacts on additional investment year on year. And finally, there's a set of macroeconomic variables which, according to related literature, will be key determinants of sovereign yields. They include GDP per capita, real GDP growth, inflation, debt to GDP, the trade openness index, and current account balance. And in terms of frequencies, all variables in this model are annual. So I have three key hypotheses for this research. The first being that low carbon infrastructure investment, specifically rail and renewables, will be negatively associated with sovereign bond yields. So the rationale is that countries investing into sustainable infrastructure will lower their climate transition risk, and so too their cost of debt to reflect this risk. So here, low carbon infrastructure investment is simply any infrastructure that reduces the CO2 emissions of a country, the use of traditional energy sources, and or replaces traditional technology with cleaner alternatives. And the use of rail and renewables was first introduced in that same paper by Saha and Modi in 2017, which was a paper on low carbon infrastructure investment. My second hypothesis expands on the first to say that the effect of low carbon infrastructure investment on sovereign bond yields will be greater for advanced economies. Advanced countries have a greater ability to access public debt markets in general in order to, and this will help in enabling them to invest in high cost sustainable infrastructure projects. And my final hypothesis is specific to high investment gap countries, where the investment gap is simply the shortfall in infrastructure investment to 2030. And the hypothesis there is that high investment gap countries will have a positive relation between transport and total infrastructure investment, so those non-low carbon sectors specifically, and sovereign bond yields. So countries that have higher future needs for infrastructure, i.e. those with a higher investment gap, will potentially need to meet requirements through traditional and unsustainable methods, which would incur higher transition costs in the future, and that these risks will be priced into sovereign yields also. Which brings me to the groupings for the panel regression. Again, it's going to be run on the full sample of 40 countries, as well as advanced and developing countries, where the classifications for each come from the International Monetary Fund. There are 29 advanced and 11 developing countries. The second splicing of the data pertains to the investment gap, which comes from the Global Infrastructure Hub and covers 19 countries from the main sample. I've used a threshold of 20% or greater to separate high and low country groupings, and that also happened to be sort of where there was a natural separation in the data. And I think the highest investment gap in the sample is Mexico with 55%. So subsamples were used in this case rather than dummy variables to indicate the country groupings due to the fixed effects methodology, which would have absorbed a dummy on country status, as these don't change across the time series, particularly for the advanced and the low investment gap countries. So now I'll move on to the main results. To start, I will mention that the results presented reflect a log-log model, with logarithmic transformations having been applied to each of the yields, infrastructure variables, and renewables variables to account for characteristics of the panel data. And to explain the models further, because of the high positive correlation between rail, transport, and infrastructure variables in the table, I iterate between them in the models. The results on the screen at the moment show those of the low carbon model, which only estimates the effects of rail and renewables variables. As far as the first hypothesis goes, we can confirm the negative relation for the full sample as well as for advanced economies. Whilst the coefficient on rail is not significant in columns A and B, renewable contribution is negative and significant at the 1% level. And the fact that there is a positive and significant coefficient on rail for the developing countries sort of signals that there are unique characteristics not being captured by the model for each individual group of countries separate from the main sample. And the second hypothesis is that this effect will be larger for the advanced group. We can also confirm that, but only for renewables and not for rail. This signals that sort of aggregate rail investment as a variable doesn't provide the adequate carbon emissions information from this type of infrastructure to be imputed into sovereign yields in the same manner as renewable energy. The R squared and adjusted R squared for the advanced model are nearly double that of the all countries model, and the R squared measures for the developing countries also follow suit, suggesting that the grouping of countries is necessary to capture their unique relationships with infrastructure. Interestingly, the coefficient on the second renewables variable is also larger for advanced countries and significant across all groups. The opposite coefficients on these two renewable variables make sense in light of their differences. An increase in yields being associated with higher renewable ton of oil equivalent is simply being interpreted as a higher energy intensity of a country, as it's an absolute measure. Contrastingly, an increase in the renewable contribution, which is a percentage, reflects a country making progress towards a lower carbon intensity of its energy landscape. And the results presented in the table are consistent across both the 10 and 3-year bond yields with varying levels of significance, which is particularly interesting when looking at the coefficient of renewables contribution, as similar variables have only been examined in relation to 10-year bond yields or bond yield spreads in the past. And the second set of results relate to the third hypothesis specific to high investment gap countries. I find opposite relations between investment into transport and infrastructure with sovereign bond yields. Though not significant, yields are negatively associated with infrastructure and transport. For countries with large shortfalls in infrastructure, investment on the basis of climate risks or emission levels may not be as critical as meeting basic economic needs. Also, it could simply be that these countries historically underinvest into infrastructure, and so this results in the negative relation. The inability of infrastructure variables to explain bond yields is represented in the adjusted R squared, which are almost double the level for the low gap countries, suggesting that there are some unique characteristics of high gap countries compared to the rest of the sample. The results in panel D show that the quality score is negatively associated with bond yields and significant at 1%, meaning that the yields on average equated to lower quality of infrastructure in high gap countries between 1995 and 2019. Again, suggesting that the underlying stock of infrastructure perhaps is more relevant than additional investment for these countries. In other results, amongst the full sample, I found a negative association with maintenance investment and 10-year bond yields, significant at 10%. So higher yields on average equated to lower investment into infrastructure asset upkeep. And I also find that a positive association between infrastructure quality score and bond yield significant at 1%. Now, referring back to the previous slide where this relationship between quality score and bond yields was negative, sort of solidifies the idea that there are unique characteristics for those 5 high investment gap countries that need to be researched further. So I did a couple of checks on robustness. The first was to perform sensitivity analysis, where I removed an influential country, in this case, Portugal. Portugal was a unique case in terms of 10 and 3-year yield behaviour due to the financial crisis it experienced between 2011 and 2014. During this period, yields spiked, and the rationale here is to remove it from the sample and see if the observed effects persist. And in fact, Portugal's presence on the sample has a dampening effect on the infrastructure variables. And I also find that renewable tonne of oil equivalent becomes more significant now at the 5% level when removing Portugal. The second robustness check was to use an alternative measure, which was sovereign bond yield spreads. This involved taking the difference between each country's bond yield and the US Treasury yield of the same maturity and removing the US from the sample altogether. I implemented this as it's kind of more commonly used as a variable in industry, and prior literature generally examines both yields and yield spreads together. The results on the yield spreads are also consistent with the yields, but with greater effects from the key renewable variables and also from maintenance investment, which becomes a more telling variable and significant at between the 1% and 5% level. So there are a few key limitations of this research, the first being that the sample is dominated by advanced and low investment gap countries, leading to potentially bias in the estimation for the developing and high gap countries. Secondly, there are data limitations for variables on both sides of the regression. For infrastructure, the issue presented has been the data frequency, as most countries only report metrics in this area on an annual basis. And there are some lags in reporting. The reason the sample only covers up to 2019 is because the data hasn't been updated since. And this is sort of the norm in the reporting, and so there's sort of no way around it. With regards to the bond yield data, further issues persist for developing countries, as many of these did not start issuing sovereign bonds until the late 2000s, around the global financial crisis. And this is sort of compared to the advanced group, which many have been issuing bonds for the full sample. These issues can be addressed by future research in a few ways. Firstly, to address issues with infrastructure reporting, infrastructure project data, as opposed to investment amounts, may provide better data quality, as well as improve the information on the sustainability of individual projects that currently the variables used in this study don't allow for. The infrastructure investment gap also is sort of a newly introduced variable or way of classifying countries. It was first examined in 2017 by Oxford Economics and the Global Infrastructure Hub, which is a G20 initiative. So time will allow for hopefully improvements in the coverage of countries in these types of analysis. And the main implication for all of this research is that these results is that it's a start in the area of climate and infrastructure, and how these variables affect the wider economy is very new. To examine how this is interpreted by sovereign markets is a step further into a developing area of research, with the results for the advanced economies in particular. This may push governments to further encourage private participation in infrastructure by institutional investors. We've seen the appetite for this with the Macquarie Asset Management closing its 6th America's Infrastructure Fund with nearly $7 billion in commitments. All in all, the takeaway should be that if government cost of debt can be reduced by improving the emissions profiles of a country's infrastructure, then governments are going to be more likely to encourage all kinds of innovation and investment into low carbon infrastructure. And that's it from me. Thank you everybody for listening, and thanks Thomas for moderating the session.